Good afternoon. It's Jeffrey Christian from CPM Group. It's Tuesday, the 23rd of February, around 4:15 in the afternoon. Thought we'd talk a little bit about silver. Following the Wall Street bets people activity in the silver market has continued to attract a lot of attention from people who are, let's say, new to the silver market. There's a tremendous amount of chatter on the internet about the potential for a default on the Comex or a crisis on the Comex, often by people who have internal inconsistencies in their thinking and what they say, and who don't necessarily have thought it all through. The Comex is a futures market, and futures are quite different from equities in that they have contract months and expiration dates, whereas stocks sort of sit there until they don't sit there. And that was one of the differences that was critical when the Wall Street bets people came into the silver market earlier in the month. There's been a lot of talk about, oh my God, there was a problem. There wasn't enough silver to meet the demand in the SLV. Some of the people were talking about how there wasn't enough silver in New York to meet the demand for SLV earlier in the month, even though the SLV metal is actually held in London. They said there wasn't enough metal around. There was 1.1 billion ounces of silver stored in depositories in London, of which about 450 million were unallocated and ostensibly available for somebody to buy if they needed it. There was some problems with settling up the contracts in the SLV in the first week of February when all of this stuff was going on. It didn't reflect the fact that there wasn't physical metal there. It reflected the fact that the daily creation and redemption of shares of SLV, because SLV is an equity, the daily creation and redemption of shares often is measured in hundreds of thousands of ounces worth of silver. And shares are created by someone delivering to the manager of the SLV ounces of physical silver, in return for which they get shares in SLV. And then the shares can be retired when when people come back and they say, here are my shares, I want the silver back. And it's not that the physical silver has to move, it's a depository receipt that has to move. It has to be transferred from one person to another, and almost all of that is computerized now. But if you look at the first 3 trading days of February, you had about 95 million ounces worth of SLV shares created. And then in the following 2 days, you had about 50 million shares redeemed. And that was the congestion. It was a matter of processing that much paper, because it wasn't one group coming in saying, oh, I have 95 million ounces of silver, I want shares. It was a whole bunch of people. It was a multitude of transactions that had to be processed. And that was the problem, and that caused the delay. There was another guy who said, well, it's interesting because if you read the SLV prospectus, it says that they only own allocated metal, and that they can own up to 1,001 ounces of unallocated metal on an ongoing basis. In other words, one 1,000 ounce bar. So basically the SLV is charged by its own charter, to always have allocated metal. There is a provision that says in a congested market, if we need to, we can hold unallocated metal, but we have to distinguish that in our reports and say, we have X ounces, X hundreds of millions of ounces, more than 1 billion ounces now, I believe, of allocated metal, and we have some unallocated metal. And there are people complaining that the SLV reports never broke down their metal into allocated and unallocated, because there was never any unallocated other than that 1,000 ounce residual bar. So there was never need to break it down because that hadn't occurred. They changed their prospectus. They said, okay, because sometimes we get backed up on the paperwork of creating and redeeming shares, it takes more than 1 day to show up. Nothing particularly nefarious, but everything looked nefarious to certain people. Now, at the end of February, they're looking at the expiration of the, well, they're looking at the first delivery day of the active March contract, and they're looking at the options expiration for the March options. March options expired today, and there was a lot of activity around the $28 range because there were a lot of puts and calls around the $28 range. And of course, people on the internet were saying that was one player that was buying and selling these options at the futures to make to try to make these options in the money or out of the money. And in fact, it wasn't. It was hundreds, if not thousands, of participants trading in the market, looking at the same prices, having the same strike prices. At the end of this week will be the first delivery day for the March contract. Now, and there are people who are saying, oh my gosh, there's so much silver open interest in the March contract. There's not enough silver to meet that demand. They'll say in the same breath, it's terrible, but 99% of the open interest in silver and other commodities is settled and closed out. It's either closed out or settled for cash, and people don't actually take delivery. That's because when you take delivery, you don't take physical delivery necessarily unless you want to. What you do is you take delivery of a depository receipt and you pay the full value. You've probably only put up 10 or 15% of the value to trade that contract, but when you take delivery of the contract, you have to make whole the full 100% value. So most people don't stand for delivery because most people in the commodities market don't use the commodities futures market, don't use the futures to take delivery. Most people involved in commodities futures don't want the physical commodities, whether it's corn or oil or wheat or silver. What they want is exposure to price changes. So they'll trade the futures and options because that's what they want. And they'll avoid taking physical delivery because they're not really interested in owning those commodities. It's very funny, and I'm sure we've all heard so-and-so took delivery of a contract in corn on the CME, and a truck pulled up to his house full of corn. No, that doesn't happen. When you take delivery of a corn contract, you get a receipt that says, oh, you now own corn in some grain elevator spread someplace in the Midwestern part of the United States. When you take delivery of a silver contract, you get a notice that says you now own silver in a particular vault. You don't get the silver delivered to your door. But what you do is you have to square up and say, I've got the money that I can afford to have the full contract's worth of silver. So most people roll out of active months. And sometimes that roll can lead to prices spiking higher. And it's kind of funny for me to have to explain this. I mean, this is something that I've watched my entire career, starting in the late 1970s and in 1980 when I was at J. Aaron Goldman Sachs, 1980 to 1986. I've always paid attention to the role of the nearby active contracts because sometimes, not always, but sometimes you'll see the price spike higher or lower due to the roll because you have that contract. So right now, today, you've got about 235 million ounces of March contracts still open as of January 23rd. So you've got 3 days before first delivery day. You can hold those until the March contract expires at the end of March, but most people will liquidate their positions before that. And you have people on the internet waving their arms saying, oh my gosh, this is going to cause silver to go to $50 or $100 or something else because of it. And it could cause a spike up. Our estimate is it could cause a spike up to $30 or $32. And then next week when the roll's over, the price would come back off. And we'll be paying attention to seeing that. And we've always paid attention to that. And now all of a sudden, there are people saying, no, this is it. And even though I can tell you that I understand that 99+% of those contracts will be closed out or rolled forward, and the delivery will not be taken. And even though I can tell you that this happens across all commodities, I'm still going to insist that right now in the silver market, this is a crisis that could lead to a default of the contract because there's not enough silver there. Well, there is enough silver there. There's about 395 million ounces of silver in COMEX recognized depositories. About 135 million ounces of that is registered. The rest is eligible for delivery, but it hasn't been delivered. But again, everyone knows that 99% of those contracts don't get delivered. There probably will be a big delivery because of what's going on in the silver market, but it'll probably be easily handled. And it's not the cause of concern about a crisis or a collapse of the silver cartel or a collapse of the silver market or a default on the COMEX. It's not anything like that. And people ought to realize that that's what's going on, that it is it is part of the nature of the futures contracts across futures. And it's happening. It could cause the silver price to strengthen in the next 3 days. Once we get into March, it probably won't happen. I'll give you a little historic perspective. In 2011, gold, silver, other commodities were all rising very sharply. March is an active contract month. May is an active contract month. In early 2011, a lot of that March open interest was rolled into May. Over the course of April, people who were short May wanted to buy back those shorts and sell forward a future contract because they didn't want to stand for delivery, or they didn't want to deliver into that contract. As they were buying Mays and selling forward, rolling their contract, their position forward to futures contract months, the price went from about $32 an ounce to $49.50, just below $50. And people in the silver market were hyping silver. There was a guy who was starting an ETF, and he said he was going to really have physical metal. You couldn't trust the big banks, but you could trust him to have physical metal there. So you should take your metal out of the big banks and everybody else and give it to him, to trust him with his stuff. And he was going to charge you a 25% premium over the price of silver to do that, but that's beside the point. And there were a lot of people trying to scare people that, oh, the silver price is exploding here. It's gone from $32 to $50. The next stop is $100 or $500 or something like that. And CPM Group came out and said, no, if you look at what's going on over the course of April, silver ETF purchases were were actually down. There was a net redemption of silver ETFs. Silver coin sales were very low because the price was high, and coin investors were saying, I'm just not going to buy at these prices. But there was about 390 million ounces of May futures that were bought back. The buying pressure that pushed the silver price up over the course of April was buying in the May contract. And that buying was not from investors wanting to be taking delivery. It was buying of short to offset short positions by the shorts. So the shorts were pushing the price up. We issued a statement in the end of April, and we said, okay, the price is $49. The price has been pushed up because of the May roll. The May roll is behind the market. We think the price is going to fall maybe back to $35 next week. It did. And, you know, of course, we were part of some grand conspiracy to suppress the price because we knew how the silver market worked. We knew why the silver price had risen. And we told everybody, no grand conspiracy. Those are the mechanics. It's like a grand conspiracy that you can make a car and you can put gasoline in the tank and it runs. And it's not a grand conspiracy. It's just the way the car works. This is the way the futures market works. So people were looking at the 235 million ounces of silver open interest as of yesterday, and they're saying, oh my God, this is going to cause a default. They ignore the fact that on February 1st, there were 681 million ounces of March open interest. And of that 681 million ounces, if my math serves me right, about 2/3 of it has already been rolled out. Now, we do have a large open interest here 3 days before the first delivery date, and it's going to be interesting to see what happens. And as I said, I wouldn't be surprised to see it push the price to $30 or $32 an ounce for a day or two until the roll is resolved, and then we get back to a more normal silver market. So heads up, the next few days could be interesting for silver, but they're not going to be cataclysmic. Take care, stay clean, stay warm, stay dry, and stay away from people who might be sick. And we'll talk to you soon.